Good day, friends. This video is dedicated to the option Greek called gamma, variable of the Black-Scholes model. You and I know that the first derivative of the Black-Scholes model is delta. In a past video I said that delta is the amount by which the price of an option will change when the price of an asset changes by 1 point. But gamma is the second derivative of the Black-Scholes model and the first derivative of delta. Gamma is the change rate of delta. Be sure to watch this video to the end to understand the importance of this Greek. Gamma risk is the primary risk of all option strategies. Look at the options board, where the gamma Greek follows immediately after delta. With it, we will be able to make the following calculations. For example, we have put options in the money of strike 27. Delta is minus 0.49. What happens to the delta if the price of the asset changes by 1000 points? Gamma is minus third power, so the delta will change by 0.19. Now the delta is 0.49, and it will become 0.68 if the asset price increases by 1000 points. With the help of gamma, we can roughly calculate how much the delta will change. At the money options have the maximum gamma. They have the maximum time premium. The delta of these options is maximally sensitive to changes in the asset price. Why is gamma an important parameter for risk calculations? So we have a sold straddle in front of us. 1000 put options sold, 1000 call options sold. If the price rises, we get minus 1 Bitcoin. If the price falls, we get plus 1 Bitcoin. If we look at the delta, it is neutral. The price is almost at the center strike, so we're looking at a neutral delta. Most books will tell you that this is a market-neutral strategy, so if the market moves, this strategy will not make losses. But it's wrong. The market does not stand still and, depending on the volatility, can move actively. In this case, we see gamma minus 396. What does a negative or positive gamma tell us? If the main role in the strategy is played by selling options, the gamma will be negative. What does a negative gamma mean? It indicates a counter-trend strategy. When the price of the asset rises, the negative gamma multiplied by the number of points of the movement gives us a negative delta. When the futures rise, we get a negative delta against the price movement. Short. For example, if the price is in the 28K range, the delta will become minus 400. On P&L, the position will get minus short 400 Bitcoin futures, 0.04 Bitcoin. If the price reaches 29,000, we get a delta of minus 680. And gamma tells us how aggressively the delta of this strategy will change. In the moment, the delta is 0 and supposedly has 0 risk. But it is not. There is a lot of risk in this strategy, but when the delta is 0 at the moment, only gamma will help us to understand the real level of risk. When the price falls, for example, minus 1000, we multiply by gamma. We get 396. 360 if the delta reaches the level of 26,000. In short, we get a positive delta when the price falls. The higher the delta, the more market risk we get. If selling options plays a major role in this strategy, a counter-trend strategy, then the delta is negative. If the main role in the strategy is played by buying options, this is a trading strategy. In this case, the gamma will be positive. Gamma should be used to assess the risk of so-called market-neutral option selling strategies. Let's see how the gamma changes over time in our sold straddle. I'm now pointing to the gamma at this point in time, and as we get closer to the expiration date, it will increase. Now I'm pointing to the gamma 1 week from now. That's 2 weeks from now. And in a month, on the expiration date, we get 0. Because at expiration, there is no time premium, there is no gamma. Conclusion. As the expiration date approaches in the sold straddle, the gamma grows significantly and approaches its maximum on the expiration date. Gamma is maximum at the strike, in this case strike 27. Therefore, here will be the maximum gamma. It can become minus 1000 if the price goes up. If the price goes down, it will be 1000. I recommend to watch the gamma very carefully. Bought options have a positive gamma, and sold options have a negative gamma. Gamma also simplifies delta hedging and rehedging. With gamma, you can customize the hedging parameters of different assets. Let's take another look at the delta chart. As you can see, as the price of an asset rises, the delta goes to the negative area. As the price of the asset falls, it goes to the positive area. And the gamma will tell us what the delta will be when the price changes by one step. Multiplying the gamma by 1000, you can immediately understand what will happen to the delta when the price moves by 1000 points. And that's all I have on gamma. As always, ask questions in the comments. If this video was useful to you, put a like and subscribe to the channel. I wish you good luck and successful options trading.